Proceed with caution. A jam-packed global macro update with over 30 charts to bring you up to speed on everything you need to know around the world of markets and Bitcoin. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today, I want to walk you through over 30 charts from around the world of treasuries, money markets, risk markets, including stocks and Bitcoin. We'll also look at the economy. And very importantly, we will go to Japan and look at the yen and try to understand what we believe to be the most important story in global macro right now, the Japanese yen. Remember, before we start, I want to emphasize that we at the Bitcoin Layer are non-linear thinkers. That means we understand the world is a complex system. Just because Bitcoin has had an amazing rally due to ETF demand coming into the market, that doesn't mean that's the only factor that's going to affect the Bitcoin price. Right now, Bitcoin and risk markets are facing global macro headwinds, and it's our goal to try to understand those and determine whether it's going to outweigh what we believe to be the nascent demand for this new technology of Bitcoin. Let's get right into it. Let's get into this first chart on inflation. What we have for you on the screen are inflation rates from around the Western world, but the long-term average of these inflation rates. So we have a 60-year chart here going back to the 1960s, and this chart takes the individual inflation rates in each country and it smooths them out over a long-term moving average. And in this way, we don't see the noisy inflation. So just as we saw inflation go from 9% back to 3% in the United States, you don't see that on this chart because each one of these lines is a 5-year average of inflation. And what have we had in the United States? Yes, it's gone from 9 back to 3, but we've also had 3 years now of above target inflation, which means above 2% inflation. And so with these long-term averages, what can we see here? The step up has arrived. We think that this step up, meaning going from average inflation rates of about 1 to 2% to now in the 3 to 5% range, that this step up in inflation is now here with us and is going to be with us for a long time. It is going to take a lot to change this dynamic and bring in long-term inflation back down. There might be short-term things that bring down inflation, but right now we see this as a very important dynamic and something that we should be cautious about and something that plays into the rest of the charts that we'll talk about today. This secular shift up in inflation is going to affect every single market, and we'll explain why. It starts with, of course, interest rates. The Bitcoin Layer is very proud to be sponsored by River, a Bitcoin-only exchange and who we believe to be the leader in the business. Go check them out today at river.com/TBL for a special offer of up to $100 of Bitcoin for free when you go sign up. You have a lot of options when it comes to buying Bitcoin. We believe River is your best choice because they do not custody your Bitcoin on a third-party exchange. They have their own solution for storage, and they encourage you to get your coins off the exchange as soon as possible. River.com/TBL for that special offer. Now, are policymakers looking at 5-year average inflation rates to impact their policy decisions? No, they're looking at spot inflation and forward inflation expectations. Now, the Fed has said over the past few months that they're ready to start cutting interest rates in 2024. It now appears that they did that way too soon, and that this December pivot from Jerome Powell was a massive mistake. The reason is that inflation has not come back down to 2% or even close. It's remaining above 3, and it's bouncing and remaining sticky here. Might be heading to 4. The point here not is that it might be heading to 4, but that it's not heading to 2. The Fed has had to walk back essentially all of their cutting projections from the market perspective, and they have accomplished that somewhat. As we see on this next chart, we have only about 25 basis points of cuts priced in for this year, 2024. and only about 75 to 100 basis points of cuts over the next couple years. That is a huge move away from about 100 basis points worth of cuts in 2024. Now you have that same amount throughout 2024 and 2025. So the Fed has accomplished its goal in removing the cut expectations from the market. We will talk a lot today about financial conditions, but to summarize what financial conditions are, this is how easy it is to get business done if you are a bank or a dealer of sorts. So we're talking about the expense of doing trades, how expensive is volatility, how expensive is funding. And in this way, lower interest rates make the whole market more confident to do business. Lower interest rates then make financial conditions easier. And the Fed responded to those easier financial conditions and said, no, the financial conditions getting easier is going against our mandate to get inflation down. So we have to remove those easy conditions right now. And they started talking the market back, and you saw cut expectations removed from the market. So now, where does the market think that the policy rate is going to be from here until the election? Basically, unchanged. That is a huge, huge shift from where we were just 3 months ago. And let's talk for a second about what we got wrong at the Bitcoin layer. It's important. It's very important to always be reflecting on the calls that we're making, understand what was correct, what was incorrect, and then why was it incorrect. So what did we say? We said that the market is pricing in cuts. We're probably going to have cuts by June. That was our assessment based on the interest rate market and what was being priced in. What did we miss? We missed how quickly easy financial conditions can not only translate into asset prices, but into the spot inflation numbers themselves. So what do I mean by that? Let me walk you through why we missed that. And I recommend you guys go check out the show that we did this week with Craig Shapiro, his second appearance on our channel. And this episode with Craig Shapiro, in which he talks about Bitcoin, but he also talks about global macro and interest rates and the FX markets. Shapiro says that the speed at which the financial conditions eased translated so quickly into inflation because of dynamics like the corporate bond market. So this is something that we identified during March. The corporate bond market had issued a record amount of debt. Why did it issue this record amount of debt? Well, starting in December, Powell pivoted policy. So he said, we're probably going to cut soon. That sent interest rates lower. It also sent a confidence wave throughout the markets. The confidence wave then boosts risk markets. Part of boosting risk markets is stocks go up and corporate bond spreads go tighter. I have a chart for you guys later on that. When corporate bond spreads go tighter and interest rates decline, it means the cost to finance and the cost to raise money at corporations is diminished. It's cheaper. So corporates borrow money in large size, and they did in Q1, record size. They use some of that money and spend it on projects, so those deposits get into the system. They also spend some of that money on boosting stocks, which sends stocks higher. Higher stocks greases the wealth effect, which is when people see their portfolios go up and they are more confident, so they just spend more money. Again, circulating deposits throughout the system. And what does more demand and more spending in the system create? More inflation. And so a Powell pivot in December might have, by March, genuinely impacted inflation, where the Fed actually thinks that their policy rate is 6 to 9 to 12 months lagging. What if it's only 2 months? And what if it's rhetoric? What if it's not the policy rate? What if it's the rhetoric And what if it's 2 months or even 1 month or even 1 week sometimes when you talk about the wealth effect? Stocks go up and they have a tremendous week. That weekend, people are spending more money. And this is the mistake that Powell has made. It's a huge mistake, and it's reminiscent of an Arthur Burns mistake. Readers will know that I am deep into the financial history right now. Go check out thebitcoinlayer.com/subscribe for our free research publication. You can check out our thoughts there. I'm going into the financial history. Powell wants to be Volcker. I'm trying to learn about Volcker. Powell wants not to be Arthur Burns, but what did Arthur Burns do? Arthur Burns cut rates because the economy was showing weakness even though inflation wasn't coming down. Powell didn't cut rates, but he said we might, and that might have been an even bigger mistake than Burns cutting rates. That we can only know after everything plays out. The point here is that Powell, when he pivoted in December, made a mistake that has actually translated into financial markets to the point where they had to walk it back in April. So this chart here shows them walking it back, interest rate cuts being removed from the market. The next chart I have is a look at global central banks. We have shown you this chart. The blue line here is Switzerland cutting rates, being the first Western central bank to cut rates. That's why you see the dark blue step lower. That was their cut. We thought that Canada would be next. Canada did not cut rates, but you can still see that purple line is downward sloping. So the expectation of interest rate path in Canada is still downward. But one interesting thing to point out here is that in black, you have the Australian central bank, and then the gray line that extends past today is upward sloping. So the expectation is actually back to interest rate hikes in Australia. So this dual-sided risk to central banking rates is now starting to tighten financial conditions. We've talked about the mistake in easing financial conditions. We are now rotating to tighter financial conditions. The tighter financial conditions are affecting the rest of the markets, which we will show you with the rest of our charts. Keep watching, guys. We have a lot of charts, and in order to understand the whole framework, you have to see all these pictures and then think about them together as one system, one complex system. Then you can see just how difficult it is for portfolio managers to do their job when they have a multi-asset portfolio. You might think it's as easy as just buy Bitcoin and go to sleep, but with Bitcoin's 3-year bear markets and 80% drawdowns, that's going to get a lot of portfolio managers fired in the meantime. So they have to have these complex frameworks, and it's our mission and my personal goal here to help you get those tools in your toolkit with these charts, with our research letter, and with these videos. Let's take it now to US Treasuries. We're going to go away from the central bank rates and go to the market rates. So in US Treasuries, we have the chart of the 10-year yield here over the past 5 years. What do you see? You see the uptrend in yields. This is the uptrend in inflation visualized in the market. Why do yields go higher in government bonds when there is inflation? It has nothing to do with credit risk. I want to emphasize that right here at the beginning. The yield curve has components of credit risk, supply risk in it, but what we are talking here right now doesn't have to do with the credit worthiness of the US government. This is simply a time value of money exercise. To be more accurate on the time value of money side, we could be looking at 2-year yields or even 1-month bills, 1-year treasury bills, something like that. But we're looking at the 10-year yield because it is considered the most liquid, most convenient dollar storage mechanism on the planet, because we don't want to have, if we're portfolio managers, we don't want to necessarily have the risk of rolling 3-month bills every 3 months when they mature. We like to lock our money up in dollars to keep it safe over a long time horizon. That's the perspective of a portfolio manager that manages against a dollar mandate. The Treasury instrument is their safe haven. We're not talking about Bitcoin. We're not talking about gold in this conversation. Mind you, those are separate assets and they have their place in the monetary system. Of course, this is the Bitcoin layer. We understand that. But for this conversation, we're talking about why Treasury yields go higher when inflation goes higher. It's time value of money. So if I have dollars and I see inflation is at 3%, and I'm offered a yield of 6% guaranteed for the next 10 years, I might take that deal because I know that with 6% coupons coming my way, I will be able to keep up with 3% increases in the cost of living. So with inflation going from 1% to 5% over the course of the pandemic, 5% and beyond, and not coming right back down, that has sent average inflation higher, and it has sent the yield demanded by the market, the time value of money, higher. And that's why yields have gone higher, and that's why they're not coming down, because there's no genuine inflation decrease expectation. There's no disinflation expectation in any genuine way. The market tells us this. If yields come screaming down, and they absolutely can, I'm not here to declare death on deflation and death on disinflation. The powerful technology forces of disinflation are still with us. People might want to go check out all of our Jeff Booth episodes in which the deflation narrative is so important to understand why technology is by itself deflationary. So it's not that we are immune to that narrative or that we are dismissing it wholeheartedly. It's that we have to look at the market. Now, with yields higher, we can see the market refusing to price in any disinflation. We'll be watching for it, but right now it's not there. So these yields are going higher, and it is translating into everything else. What are higher yields causing? They are causing weaker stocks, and that's why it's important to start with inflation, then the central bank, then yields, market yields, then we can get into risk. Why is risk suffering? It's because the equity risk premium is declining. What is equity risk premium? It's the premium that we get for holding stocks because they're more risky versus holding US Treasuries. So we look at the compensation from the stock market right now and we compare it to yields, and what is going to happen at the margin if yields go up? The only thing that can happen by itself is that equity risk premium declines. Why? Because you're getting more money to put your money at the Treasury. So that means on a relative basis, you're getting less money from equity. And that relatively less money, it decreases the investment case for equity and risk. And so that's why we start with yields, but we see it play out in the stock market. The next chart, of course, the S&P 500. We see the uptrend intact for Q4 of 2023 and the first quarter of this year, but it has rolled over. The stock market has broken trend. It has had some weakness of late, down about 5% from the all-time highs. So no massive bear market or anything of the sort. But what we have right now is tightening financial conditions. And this is why we started the episode with proceed with caution. Easy financial conditions have turned to tight financial conditions. They are not extremely tight, we'll show you that. But they are tighter than they were. And the shift has moved from easier to tighter. And so everything is at the margin. You might even be tired of me hearing that, saying that phrase over and over again, at the margin. Why do I say it so much? Because the shifts that happen in markets are not the whole market going from buy to sell. It's just a few people, a few investors going from buy to sell. And that shifts the sentiment. And that brings more sellers. And then that brings more sellers. So that's why the shifts are marginal, is because we're looking for when things flip from positive to negative or negative to positive. So right now, financial conditions are shifting from easier to tighter. Stocks are rolling lower. And these are the red flags that make us tell you to proceed with caution. And specifically, what are we being cautious with? Exposure to risk assets. And not only exposure to risk assets, but the whole monetary system itself is right now something that we want to be proceeding with caution. That has to do with what's happening in Japan, which we are going to talk about toward the end of this video. The shifts in Japan might be the most important story, even more than inflation. It's not our job to say that right now Japan is more important than inflation, but we have to factor in both of these things. So we'll talk about Japan here shortly. Let's go to the next chart. Sticking with the risk markets here, we are going to talk about the correlation between Bitcoin and the stock market. So here on the top pane, we have the Bitcoin price hovering between 60 and 70,000. We'll talk specifically about price action and levels here in a moment on Bitcoin, but I want to show you a chart of just the correlation with the stock market. So on the bottom pane, we have a rolling 100-day correlation between Bitcoin and the S&P 500 daily returns. And 0.86 basically means that 86% correlation between these two assets on a daily return basis. It means that on days when stocks go up, Bitcoin goes up, and on days when stocks go down, Bitcoin goes down. Now, the return profile can diverge significantly. Imagine Bitcoin going up 10% every time that the stock market went up 1%. You would have very different returns on these two assets, but very strongly correlated assets. So correlation does not mean returns that are necessarily equal or even similar. It just means that their price relationship on a day-to-day basis is strong. So when we say proceed with caution because tighter financial conditions are affecting the stock market, those conditions can affect Bitcoin too. They can affect Bitcoin. And so right now, the headwinds, we have to call them out. And so that's why we should be cautious. And I'll show you some good levels of support on the Bitcoin chart so that you can judge for yourself. Remember, this is not investment advice or trading advice, so you can judge for yourself what's going on with the Bitcoin price and is it being defended in this bull market or is it breaking down? Right now, there's no sign of it breaking down, but we're close to a couple levels, so I'll show you those here. Now, on this chart, I have some trend lines here to show you some potential support levels on Bitcoin. The green line is an uptrend that we've had basically since the first big dip after the ETF approval. That rally that we've been in right now looks like it has support somewhere around the $62,000 area. So today, with Bitcoin trading around $63,000 here on Friday, April the 26th, this is pretty close to an area of support. We'd like to see Bitcoin bounce there. If it doesn't, it sets up a move back down to the 50s, somewhere between $50,000 and $55,000. That would be the trend line that we had since the court ruling, which showed that Grayscale was being treated unfairly by the SEC. That was the decision that paved the way for ETF approval. So the dark blue line is your court case Grayscale trend line, uptrend. And the green one is the current hype rally. And that's why that one might not hold, and it still wouldn't affect the bull market. The dark blue one not holding would affect the general sentiment in this bull market. We would then be looking at a Bitcoin price that is falling below the trend line and trend support levels. So 62,000 and 52,000, these are just round numbers. They're based on a single line drawn on a chart. I'm not even using candlesticks on these charts here. So take them with a large grain of salt, but I want to show you guys what I'm looking at on my trading station as well as my macro bond charts. Of course, the halving watch begins. These red vertical lines are the third and fourth halving. So this chart looks at about the last 5 years of Bitcoin price action. What do we see after halving 3? A big rally in the Bitcoin price in orange. What do we see after halving 4? Nothing, because it happened last week. So we are going to be watching Bitcoin's price action. Can it have another reaction to the halving that resembles past halving post price reaction time periods? Potentially, yes. And so with that, we will be watching. We are looking at Bitcoin's valuation relative to its realized price, which is now almost $30,000. We really like to see this. This means that to us, there is a floor at around $28,000 to $30,000 on Bitcoin. Not that it can't be broken, but that historically realized price has been an excellent price floor for Bitcoin, as the aggregate network usually doesn't like to hold on to Bitcoin at a loss for very long. So those Bitcoin get hoarded when we get to levels below realized price, and the price tends to shoot right back up. So right now we're at a ratio of about 2.25 of price to realized price. That's our MVRV ratio there in green. 2.25, pretty muted. We're happy with that. It's not an overextended market by any means. And so that might be a function of Bitcoin waiting for more demand to come into the market, more speculative demand. But it also might be a function of tighter financial conditions, which means less liquidity in the market. Liquidity can mean a lot of different things to a lot of different people. But what it means to us is how much money is sloshing around. And how much money is sloshing around is marginally less today than it was a month ago. That is because of what we have seen with the Powell and Fed walk back of the December pivot. Let's shift gears into the economy. Now, I want to show you the US economy from both sides, the good side and the bad. We see metrics that show the US economy is very strong, some that show it's doing just okay, and some that show some caution. Right now, with easy financial conditions most of the year in 2023 and to start 2024, we don't expect any immediate slowdown in the economy. That can only happen once financial conditions get much tighter than where they are currently. So are we in the process of that right now? It could be, but when we look at the metrics, we should expect the economy to be doing somewhere from okay to quite well. It's also important to keep in mind what we said earlier about the lagged effects of monetary policy. We talked about the immediate effects of rhetoric, which means the Fed can move around financial conditions, therefore markets, therefore spending, but it also has a lagged effect with its interest rates themselves. Why? Because when interest rates are hiked at the central bank, that translates into other borrowing rates. And of course, again, at the margin, there will be companies and borrowers that can't afford the latest hike. And those people then stop spending or have to go bankrupt and fire people. And those people then slow down the economy. We haven't seen that happen too much since the Fed has started hiking rates 2 years ago. And that is shocking to many and was quite surprising to us as we progressed last year, but it became more obvious to us that there were other factors impacting the economy, specifically historic fiscal deficits that were translating into more spending and more spending that remained in the economy. And that refused to give way to the higher interest rates. Remember, it's a tug of war. And so the Fed is trying to slow down the economy but can't. That doesn't mean they're not trying. So as they are trying, as they have raised rates, some industries, some companies, some borrowers will feel that impact. Others will not. Others will benefit more from the fiscal spending. Others will benefit from other places of demand in the economy. And so we have a few charts here to show you some of the good and some of the bad. We'll start here with some of the good, and that's the employment market. The employment market looks good from the headline statistics perspective. In orange, we have continuing jobless claims. This is how many people are on unemployment assistance around the nation, muted. Off the lows for sure, but muted. And the unemployment rate, 3.8% in purple. Off the lows again, but muted. So the Fed is watching both of these metrics very closely because the reason that it doesn't have to cut rates right now is the employment market is strong. Also, inflation is hot, but it doesn't have that dual-sided risk. It only has one risk, which is inflation. It doesn't have the risk of higher unemployment. You see that on the chart here. So because it doesn't have dual-sided risks, it only has one risk. The market has finally figured that out, and the Fed has figured it out that they can't get away with saying we're going to cut just because they think inflation might be coming down. The decision for the Fed to say we might be cutting soon might be way more political or geopolitical driven than we are giving credit to, but we have to take what we are given right now, which is what the Fed says, not what we can speculate they're doing behind closed doors. So right now, the Fed said that they were going to cut in December. Mistake. Inflation picked back up. The economy just hasn't slowed down. Unemployment tells us that. The next chart shows a little bit of the bad side of the U.S. economy, and these are what we believe to be the lagging effects of monetary policy tightening, delinquency rates on the rise. So in red, credit cards, in green, autos, and in orange, you have mortgages. Yes, people are getting late on their payments. These are quarterly metrics that we have here, quarterly releases. So this is not brand new data. We actually showed you guys this chart in our research publication. Again, thebitcoinlayer.com/subscribe for our free research letter. These delinquency rates show that the consumer is starting to struggle. And even though unemployment hasn't gone up that much, delinquency rates have. And you have, from a mortgage perspective, higher delinquency rates than where we were during the pandemic. So are assistance programs rolling off? Are job cuts translating into delinquencies but not showing up that much in unemployment claims and the unemployment rate because people are finding ways to earn some money that keeps them out of the unemployment statistics but makes them late on payments? Something like that might be the case. So we can't just look at one metric in the economy to get a sense. We have to look at many. Now, this next one is slightly related to the economy, but more of a banking metric here. These are loan loss provisions at U.S. commercial banks. So this is how much a bank on its income statement has to show that it's expecting to lose on loans that default to them. So banks make income when loan payments are made to them. That's interest income for them. And then when defaults happen, they have to write down that asset. It means that the size of their balance sheet might decrease and they have to translate for that on their income statement by declaring a loss. Instead of just suddenly declaring losses on defaults, they have to budget for them. So the green line is that budget up to about $200 billion of loan loss provisions at commercial banks. This is up near pandemic levels and up quite a bit off of 2022 levels. And that's at about 1.77% of the total loans on the balance sheet of those banks. So If we get to about 2% on this provision, does that mean that we have automatically crossed some threshold? No, but we are watching loan loss provisions as well. This is something that will tell us that US banks are expecting the economy to slow down materially. And so this increase in the green line is that expectation. Does it ring crisis? I don't actually know, but we're going to watch the direction. We'll definitely be watching this 2.25% threshold from the pandemic to see if banks are genuinely worried about the US consumer. Back to those tighter financial conditions that the Fed has placed on the US economy, higher mortgage rates above 7%. And notice what happened late last year, beginning of this year. A big decline, almost 8% down to below 7%. So a decline in about 1% of mortgage rates. That helped. That boosted inflation. That boosted the housing market. That did something at the margin to help the economy. And so when rates go back up, that's going to slow things down again. And so that's what we're seeing right now. Higher interest rates, higher mortgage rates, tighter financial conditions. Proceed with caution. 3 more quick charts here on the economy. Housing sales, not great. We have here a combination of new and existing housing sales. We see them at about 5 million homes. This is down significantly from the 7 to 7.5 million homes annual rate that we saw during the early years of the pandemic when a lot of people were moving around the country. Home sales definitely down, and the reason that home sales are down is because there's a slowdown on both sides of the market. Sellers don't want to sell to give up that 3% mortgage, and buyers can't afford 7% borrowing rates. It keeps prices high, it keeps inventories low, but it also keeps sales low. We saw delinquencies on the rise. Will delinquencies rise to the point where there gets new supply onto the market in a foreclosure wave? That's something we have to keep our eye on and think about, but the statistics don't tell us that that is here yet. So we'll watch home sales, we'll watch home prices, we'll watch delinquencies, and of course, mortgage rates. Car sales in the US, about 15.5 million on an annualized rate. This appears to be rolling over somewhat versus about a decade ago, in which the boom in the economy during the 2010s resulted in auto sales at about 18 million vehicles annualized. So 15.5, not great, definitely up from 12.5 or so during the early years of this decade, but they do appear to be stalling out here. So is the economy off to some huge wave of spending based off of auto sales? It doesn't really look so. Last chart on the economy that we've been watching. This is NFP data, but looking only at transportation and warehousing workers. Negative year over year growth. It means that payrolls are falling versus where they were a year ago. We can see a little bit of uptick. Remember, rate of change is really important. So even though those payrolls were rolling over, they appear to be rolling over at less of an intense pace versus a few months ago. So the reason that we have this chart here is because when transportation and warehousing workers are fired, it's a bad sign for the economy. And as you can see with the gray shaded regions of previous recessions, the tech recession in 01, the great financial crisis of 08, and then the pandemic in 2020, this metric went negative in all of them. Now, the distortion of the pandemic on all of our charts and all of our data is it shows what it shows you is that period during 2020 to 2022 was so extreme from a historic norm that it might take years for equilibrium to be reached. So while we're looking at this chart and trying to extract signal from it, there might not be any signal because of what happened in 2020 and then 2021. So again, the takeaway here for the US economy, some weakness and some strength. We'll have to let it play out, but definitely no sign of recession as we speak. Let's shift to money markets. We have here on the screen one of our favorite charts. It might be one of the most boring charts that we have. We understand that. This is SOFR relative to the Fed's policy corridor. So these rates, the reason why you have 4 rates here that are completely flat, these are the Federal Reserve policy rates. Their repo rates and their lending rates that they have out to the market. And in black and orange, you have market repo rates. So those repo rates are fluctuating inside of the corridor, and the Fed is happy. This means that repo rates in the market, dealers borrowing money from money market funds, for example, these rates are exactly in line with where the Fed wants them to be. So, does the Fed need to worry about any financial plumbing? This chart says no. But as we know, these changes in money markets can happen extremely quickly and suddenly. So this is why we monitor it every day. Back to risk markets and financial conditions. I told you we would have a chart on corporate bond spreads. So what I have here is corporate bond spreads in orange, and the other line is the stock market, but it's inverted. So the stock market here going up would be a declining line. And so you see here over the past few weeks, the maroon line going up, that is stock market weakness. Corporate bond spreads going up, that is tighter financial conditions as we get an increase in corporate bond spreads. That means more expensive for corporates to borrow. Spread means the addition in yield to Treasury. So 1.5%, you put that on top of a 5-year Treasury, which is at about 5%. And in that way, corporate borrowing in the 5-year part of the curve is at about 6.5%. The reason that I'm showing you this chart here is that financial conditions starting to tighten. It's not just stocks, it's corporate bond spreads, it's everything. So again, only 5% come off in the S&P 500, might just be a consolidation, but our focus is on financial conditions, central bank rhetoric, liquidity. We're very excited to bring Michael Howell back on the show here in a couple weeks. I'm going to get to interview him alongside Joe Consorti for the first time and ask him a ton of questions on liquidity. What are the shifts that he's seeing? And we selfishly are trying to understand his framework as much as we can so that we can employ some of those techniques ourselves and try to understand those liquidity dynamics in the market. Here is the Chicago Fed's Financial Conditions Index. This combines volatility, repo funding, corporate bond spreads, other securitized bond spreads. It combines them into one index to tell you easy or tight. And right now, it just doesn't look like there's any tightening yet. The easing of the past year plus 2023, that has not really turned yet. This is a weekly metric, so we'll be watching this closely. But again, this metric is just a lagging weekly metric of what's going on in the market itself. So if you really want to know what's going on in financial conditions, all you have to do is look at the stock market and the US Treasury market, and it'll tell you essentially everything you need to know. Let's shift gears to the US Treasury market, another core component of our framework at the Bitcoin layer. What is going on in the Treasury market and what do we have to be looking for? Well, next week, we have a huge announcement from the Treasury Department. We are going to get the issuance numbers for the next quarter. This is the quarterly refunding announcement that has been market moving over the last several quarters. What is the big mystery? It's not necessarily how much money the Treasury is going to borrow. We know they're going to borrow a lot. It's where they're going to borrow the money. Are they going to borrow it in bills? Are they going to borrow it in 2-year notes, 5-year notes, 10-year notes, or 30-year bonds? We'll have to wait and see. In the next couple charts, I'm going to walk you through why it matters what part of the curve they're going to issue in and what our expectation is. But in this first chart, I'm just showing you the issuance numbers on the gross and net level. So the orange bars are how much Treasury is printing every month in terms of issuance. Right now, at a pace of about 2 trillion in paper per month. Now, the black line is the adjusted and the more relevant number. That's the net issuance because treasuries mature all the time. So if we look at 0.12 trillion in the latest net number versus 2 trillion, what does that mean? It means the treasury issued 2 trillion in treasuries during March, but used 2 trillion of that, used 1.9 trillion of that to pay maturities. So there's a lot of debt coming due all the time, and a lot of the debt that the Treasury issues just goes right back to paying off stuff that matures. The black line, though, matters because the net amount being issued by the Treasury going up means the debt goes up. And so what we have right now is hundreds of billions of new Treasury supply on a net basis every month. A big picture chart for you here, the Treasury supply going up every month because there's more borrowing than there is paying back maturities. That's the green line, $34.5 trillion of U.S. Treasury debt. How does that compare to U.S. stocks? U.S. stocks above 50 trillion, so Treasuries a smaller market by themselves than the U.S. stock market, and Bitcoin, just lowly Bitcoin, at about $1.25 trillion in market cap. Now, let's talk about Treasury bills versus coupons. What is the Treasury going to do and how does it impact the market? Let's just talk about the coupons themselves for a second. So this is non-bills. The Treasury has two options, issue short or issue long. Obviously, there's nuance there because they can go between 1 month and 30 years, so there's many points on the curve. But let's just think about bills or tens in this example. So if they issue more tens, that means that the market is going to have to absorb risk. Why are tens risky versus bills? Tens are risky because they have what's called duration, which is price sensitivity to changes in interest rates. So if rates go up, those that own tens are going to lose a lot of money. If rates go down, those that own tens make money. But with bills don't have duration, or their duration is minimal. So when you own bills and bill yields go up, you don't lose money. The bill just matures and you buy a new bill at the higher yield. And that's why bills don't have risk relative to tens. So that's the most important thing to understand about QRA. In a decision of bills versus tens, the issuance of tens is more complicated for the market to absorb because that's risk to the market. The market will have to sell some other sort of risk to buy that tens risk. And so when Yellen and the Treasury Department hit the market with coupons, means non-bills, means long end issuance, that is introducing risk to the market, the private hands. Okay? So then if Yellen issues more bills, that means less coupons. That means less risk to the market. So by itself, more coupons is going to be harmful to the market. By itself. Of course, that is just one factor, and there might be other factors that drive them one way or the other. But just on an all else being equal basis, more coupons will be dangerous to the market because it's more risk to the market. Now back to bills. What are T-bills? T-bills are basically the plug. How much does Yellen decide to issue in terms of long end issuance, and whatever she doesn't decide to issue there will be done in bills. So bills as a percentage of total Treasury debt, now you see the green line here fall from 35 trillion to 27 trillion. The reason that I've done that here is we're only looking at marketable debt. This is debt that's not owned by the Fed, not owned by other government agencies, and is owned by the private hand. So 6 trillion in bills and 27 trillion in Treasury total owned by private hands. That's 22% of Treasury supply in bills. That is historically very high relative to the last couple decades, but not as high as it was in the 80s and 90s, it looks like on this chart. So the Treasury can issue a lot more bills and not be way out of context with historical norms, even though it would be out of context with the last couple decades and its stated policy in which it said it wants to be between 15 and 20% bills. Does the Treasury say we want to change that target to maybe 25% bills? That would be a big deal and maybe a market moving event. But the point here is that if Yellen doesn't want to introduce risk to the market by issuing long, she can. She has the room to do so. So we don't know what to expect from her. We think that she should be issuing some coupons because the yield curve is inverted, so it's an opportunity. It's also an opportunity for her to test the market. How illiquid really are 30-year treasuries? I don't think anybody really knows, because when they do get illiquid, we get the Fed coming in with rescue. Remember that the Treasury issued trillions in bills during the pandemic to fund stimulus, but the Fed bought 30s, amongst other things, because 30s were being dislocated in the market. They weren't trading very well. They were trading sloppy. So is there sloppy liquidity out in the 10 to 30-year part of the Treasury curve? Perhaps. We don't really know for sure unless Yellen hits the market with some more issuance. So what to expect from Yellen? It's really hard to say. I think she will issue long. Maybe not as much as might be feared, but I do think she will try to test the market and won't necessarily drive bills back up to 25-30%. So it will depend on tax receipts also. We will be covering everything for you guys next week on quarterly refunding. And don't forget, the FOMC meeting also is on Wednesday, May 1st. Let's look at Treasury supply relative to other money metrics. So deposits here in purple at about 17 trillion, starting to increase again here after a decrease throughout most of 2022. Money market funds at about 6 trillion and reserves hanging out at just about 3.25 trillion. Declined in the last H.4.1 release from the Fed as there was a big jump in tax receipts, a decline in reserves. Those are basically people paying the government tax money from their bank accounts to the Treasury general account. So why do we care about reserves? We care about reserves because they make the other lines here liquid in that you can move them from one place to the other. To buy a Treasury security from a deposit, you're going to need a reserve. To get from a money market fund back into a deposit, you're going to need a reserve. To get from a deposit into a money market fund, you're probably going to need a reserve if that's some sort of interbank transfer. So transfers between banks and the government, which has to do with Treasury supply, those all require reserves. That's why the Fed has said they want reserves to be a percentage of GDP, so that if GDP is rising, reserves are plentiful to assist in money transfers throughout the economy. So we understand reserves and their function in the system, and we are watching the quantity of reserves. If they fall too much, the Fed is going to have to do something. We don't know if they'll call it QE or something else in terms of having to increase the amount of reserves in the system, but they will have to do something. Just what is that point? We don't know. Let's shift gears back to the money market and the central bank. We're looking at the Fed's balance sheet here. We're talking about reserves. When is the Fed going to have to increase the amount of reserves? Well, let's take a look at the Fed's balance sheet and try to understand a little bit about this current period of QT2. I have quickly on the screen for you the QE periods and the second QT period. Remember, QT1 ended abruptly with the repo crisis of September 2019, had nothing to do with the pandemic. The Fed did expand its balance sheet after that, but the expansion started with a repo crisis. So again, a scarcity in reserves. That's what we're looking for. With reserves marching lower, the Fed knows that it's going to have a problem. So on Wednesday, May 1st, does the Fed say something about slowing QT? Maybe, but with inflation where it is, can it get away with it? We think that they can. Not that we are expecting necessarily something on May 1st, but we think that they can, just given where the Fed has started to separate policy on rates and policy on balance sheet. Remember, in March of 2023, the Fed kept hiking rates even though it expanded its balance sheet to deal with the Silicon Valley Bank crisis. Now, let's dive into that QT period here. The decline that you see, where is the decline? It's in Treasury securities in red and mortgage-backed securities in green. Now you can see the decline in mortgages is less steep than the decline in treasuries. Going to the next chart, let's think about those mortgages owned by the Fed. Those 2.3, 2.4 trillion in mortgages now here in orange on this next chart, where does it stack up against the rest of the market? The rest of the market is the purple line, so that's the non-Fed owned portion, and the total is in green. So about 12 trillion in these agency mortgage-backed securities, 9.5 of them owned by the private market, and about 2.5 trillion owned by the Fed. What is that on a percentage basis? About 20%, down from 25%. Now let me ask you a question. Do you think the Fed going from owning 25% of the agency mortgage market to only 20% is going to have an impact on agency spreads and the premium that investors demand for owning these securities? We believe so, and we think that this will start to affect the market in ways that nobody is really talking about right now. But I want to include it in this chart pack for you guys here to let you know we are thinking about things other than just how many treasuries the Fed owns and what's going on with the treasury deficit. There's also this enormous agency mortgage-backed security market that requires funding. The private market has to fund it when the Fed doesn't. And if the private market funds it, that's volatility it has to absorb and gets introduced elsewhere into the market. So Fed balance sheet wind down matters. I don't care what those that say that it's just it's not spendable money, so it doesn't impact. It impacts the psychology of the whole market. And it really matters. We're going to be watching mortgages and mortgage spreads to see if the Fed starts to worry about this too. I mentioned the TGA getting tax receipts. That's this little jump in red that you see here. Nearly $1 trillion now at the Treasury General Account. That was joined by a dip in reserves, the orange line. And of course, the reverse repo facility down to less than $500 billion. It might be stopping here as the money market just wants to keep 300 to 400 billion at any given point with the Fed overnight as dry powder really in the money market to buy longer bills or something else in the market if it needs to, or to fund withdrawals. Remember that these money market funds must keep daily and weekly liquidity. So instead of holding 1 week bills for daily liquidity, it might just be holding RRP. Last chart on the Fed's balance sheet here, I have a line item that I haven't seen a single person talk about yet, but maybe this is the second or third time I'm covering this. This is repo done at the Fed from foreign accounts. It's now at 364 billion. So there are entities that have treasury holdings that need cash and are pledging this with the Fed and borrowing cash from the Fed, meaning that the Fed is issuing money to foreign entities. So this is like a bank account for foreign entities, sovereign wealth fund, sovereigns and global central banks that can use this facility. So it's very interesting for us to see more money being lent out from the Fed using Treasury collateral abroad. We don't really know what the cause of this is yet, but we are watching it to see if this is a sign of potential weakness in euro dollar funding, which means do Is there a dollar shortage abroad? This might be a metric, and I promise to you guys I will be looking into this more. Let's shift gears here to global foreign exchange rates and commodities. The gold market is telling us something is going on in the global monetary system with this big breakout above $2,000. Does it have to do with China? We think it does. So let me play out the thesis here a little bit for you guys. China is probably entering a period in which it has to do something major on the policy level to help its economy out. China has a very weak economy right now and has to respond with something. Two options are a fiscal response and a monetary response. A fiscal response is the Chinese government spending a lot of money on building projects, infrastructure, and doing government spending. Monetary policy, it could lower interest rates. But there's another thing that China can do. It can let its exchange rate find a more natural position. Right now, China has a managed exchange rate. And so, what is the going thesis that I've had for a long time? China needs to deval. It needs to devalue its currency and cheapen versus the dollar. But what am I starting to understand a little bit more? It might not just be a deval, it might be the free float itself. So, something that's very hard to forecast, but this is something that we think is a factor in the gold market. So on this next chart, we see gold holdings on the rise. China now starting to announce an increase in its gold holdings on a very regular basis after many years basically saying, we don't know if they were stockpiling or not, but they declared that there was no increase. You see that orange line flatlining there up until 2022. Now they are adding gold again. Is China heading to a gold-backed currency? No, we don't believe that. We believe they're heading to a floating currency potentially. And if they own gold, it allows them to use gold in international settlement if there are trade deficits. So if China is importing from another country and it has deficits, it could potentially settle by sending gold instead of by sending treasuries or other dollar instruments. And if it has gold, it doesn't matter what the dollar is doing anymore for China because it can use gold in the international settlement. This thesis is informed by how the global monetary system used to work. Okay, so studying the gold standard and studying the 20th century, earlier 20th century monetary system is what informs me to this hypothesis. So we will continue to watch this play out. We are watching Chinese gold holdings. We're watching the US dollar gold price. We'll also be watching the gold price in Chinese yuan. Okay, I promise we're going to talk about Japan. Let's talk about the Japanese yen. The Japanese yen right now is on fire and not in the good way. It is a dumpster fire right now. The Japanese yen is devaluing versus the dollar, and it's starting to increase in the speed after it got above this 150 level. So here I have a 50-year chart of the yen. You see the red vertical line was the Plaza Accord in 1985 in September. That is when the world got together and managed the dollar weaker. So the purple line decreasing here is Japanese yen strength and dollar weakness. Now, over the last few years, we see yen weakness and dollar strength. Now up above this 150 level, which it hasn't been there really since the Plaza Accord. So 40 years, now a 40-year weak level of the yen just about and accelerating. This has the potential to unleash the global currency war. This is why we proceed with caution. This does not mean that the Bitcoin layer is expecting a stock market crash here in April. What it does mean is that here in 2024, we are watching for some big fireworks in the global markets. Starting with the Japanese yen going weaker, This forces other currencies in Asia to have to compete with Japan by devaluing their currencies to make their products more attractive to the rest of the world. Mind you that Germany is in recession. Germany competes with China. China competes with Japan and Korea. And so if Japan weakens, Korea weakens, China weakens, Europe weakens, everybody is weakening versus the dollar and versus themselves. That causes a lot of commotion in global FX, and it can cause a lot of commotion in world trade. It can lead to protectionism, and it can lead to a lot of bad things that have happened in the past if we look at past currency wars. We look here at the Japanese yen, again in purple versus the Korean won. The two currencies are trading with a strong relationship, but look at the yen. It's starting to separate. Is this going to drive some changes in other Asian currencies over the next few months? We believe that you should have caution here when thinking about these markets. The Japanese yen going weaker is potentially the first domino in a currency war. Go check out our currency war video that we did with Michael Cow very recently. It's an excellent thesis on how this can play out. This next chart here is the Japanese yen versus the Chinese yuan. Right now, the Chinese yuan is not being weakened by the government. They're keeping it here around 7.25. It's being pegged. But if the Japanese yen continues to weaken, policymakers in China are going to be forced to do something. I know for a fact that they don't want to be forced by Japanese monetary authorities to do something. They will be driven by what's going on with their own economy. So if their economy is unable to compete with this weaker yen, then policymakers will have to do something. So we don't pretend to be experts in China policymaking. What we are is observant to correlations between assets, currencies, and it is our best estimate that what is happening in Japan will have ramifications for the rest of the world. The last chart I have for you guys is on Bitcoin. My big prediction about Bitcoin is that it will approach the level of money market funds under management sometime in the next several years. That number right now is at about $6 trillion. It's not that I feel money will come out of money market funds into Bitcoin, but that it'll come out of other asset classes, namely real estate, stocks, and bonds, into Bitcoin as another type of money market fund. Now, of course, Bitcoin isn't a security, it's not a fund, and it's not a deposit at a bank. It's not a liability of any sort. It's an asset that comes from a protocol, but it is a type of money that doesn't have counterparty exposure, and that's why people own money market funds. Even though they might be issued by a JP Morgan, a BlackRock, or a Fidelity, the holdings are US Treasury bills for the most part, and the investor buys a money market fund to own cash. Well, today, we see Bitcoin taking a cash position on the balance sheets of individuals and corporations and one individual country. In the future, we believe that will continue to be the case, that more companies, more sovereigns, and potentially even banks will hold Bitcoin as an asset, making it a type of money market. Thanks for sticking with us today. Lots of charts. We hope you will subscribe to our research letter for free at thebitcoinlayer.com/subscribe for much more. We'll catch you guys next time. The Bitcoin Layer is proud to be sponsored by River. River.com/TBL for that special offer. And the reason that we love River at the Bitcoin Layer is that they put your education first. River.com/learn to understand what Bitcoin is, the fundamentals. Also, how to get your Bitcoin off the exchange into your own custody solution. You can use river.com/learn for all of that information. Go check them out today.